Welcome back to Morning Markets on Wednesday, the 14th of February. Yesterday, US inflation came in higher than expected, whereas in the UK, inflation was lower than expected. Stay tuned to find out more. The pathway of inflation to the Federal Reserve's 2% target was never expected to be a straight line. However, yesterday's reading for headline inflation saw CPI cool down to 3.1% from 3.5%, but that was stronger than was expected. They were expecting a level of 2.9% to be the final print. Core CPI, which strips out food and energy prices, remained stable at 3.9%, but month over month, we saw a slight uptick from 0.3% to 0.4%. Most of the increase in the month-over-month reading came from the shelter component, which accounts for around 40% of the core CPI basket. In terms of the reading, this increased by 0.6% over the month. Core services also added to the pressure, up 0.7%, with most of that increase coming from transportation costs. At the turn of the year, the market had started to shift their expectations, pushing out their probability expectations of an interest rate cut in March out to the summer. The market now more firmly believes that that would be the case. They've moderated their expectation of a March cut, and they're now expecting more firmly around 4 interest rate cuts over the next 12 months rather than 5, so 1% in total over the next year. In terms of the reaction, we saw bond yields which moved higher as the prospect of interest rates being lowered to the magnitude they once were thought were reduced, and the equity market was also challenged. It was the areas of the equity market in the US which are more sensitive to interest rates, such as consumer discretionary, which includes electronic component businesses, and technology, which were most challenged. More defensive areas of the market, such as healthcare and consumer staple areas, were more resilient. If we look to the UK, however, the market was expecting inflation to start to increase on an annual basis and month over month. However, what we saw in the CPI print for January was no change at headline level at 4%. This surprised the market, who thought we were going to see a reading of 4.1. And in terms of core inflation, that also remained steady at 5.1%, which beat expectations of an uptick of 5.2. On a monthly basis, we saw core inflation, which fell 0.9%. So this was a really beneficial print for the Bank of England, because yesterday we had the employment data, which showed a slight uptick relative to the expectations in wage growth, and unemployment for November actually revised down, demonstrating a very resilient labour market. So all in all, supports the Bank of England's ability to start to moderate interest rates this year, as we're seeing inflation falling in the UK towards targets. Thank you very much for watching. A lot of data to cover today, but I hope you found that useful. Look forward to bringing you up to date tomorrow here on Morning Markets.